Hello, welcome to this seminar on restructuring solutions in the light of COVID and the Pension Schemes Bill. I'm Jeremy Harris, a partner in Fieldfisher's Manchester Pensions team, and I'm joined as co-speakers by Dan Mindel and Nick Gibson of Lincoln Pensions. And this is a joint seminar, and I'd just like to introduce ourselves. Firstly, myself, I'm a pensions lawyer. I've been a pensions lawyer for 30 years, advising on the full range of pensions issues, and latterly in more recent times advising in relation to the Pensions Regulator's powers and employer debt issues and de-risking matters. Dan, Nick, would you like to introduce yourselves too?
Sure. I'm Dan. I'm a managing director at Lincoln Pensions, where I lead the restructuring offering there, where we advise trustees and sponsors in distressed and stressed situations. I've got over 20 years of restructuring experience, and I remain a licensed insolvency practitioner.
Thanks, Dan. Nick Gibson from Lincoln. I've been a covenant advisor now for more than a decade. Before that, a background in corporate restructuring. And over that time, I've advised trustees and sponsors around a really broad range of transactions, including a number where the sponsor has seen stress or distress. So on that note, over to you, Jeremy, to kick us off.
Thanks, Dan. Thanks, Nick. Next slide. So this is the agenda for today's webinar. I'm going to talk firstly myself about the legal position with a legal overview of the current scheme funding and moral hazard legislation, and then considering the impact of moving out of COVID and lockdown at some point this year, and then handing over to Dan and Nick to talk about future trends in 2021, contingency planning, and going through some case studies. Before we start in earnest, some housekeeping points. You'll see questions drop down on the right-hand side of your screen. As we go through the webinar, please put any questions you'd like to submit there, and we can aim to pick those up as we can and during the webinar. If we don't manage to answer your question during the webinar, we'll get back to you individually. Please also use that box for any technical questions, any technical issues during the webinar, and our technical team will get back to you and try and sort you out, try and help you. So next slide. So firstly, the scheme funding legislation, and when looking at corporate restructuring, it's relevant to consider not only the Pensions Regulator's powers on moral hazard, but also on scheme funding, because those scheme funding powers require the trustees of defined benefit pension schemes to consider employer covenant. And it's relevant to consider the various different types of legislation or guidance that there is on scheme funding. The Pensions Act itself sets out a framework and not much detail. Essentially, defined benefit pension scheme trustees are obliged to, as a matter of their ongoing funding, to secure that there are sufficient and appropriate assets to meet the so-called technical provisions. And the technical provisions being the scheme liabilities, the scheme benefits valued on an actuarial basis. The scheme funding regulations then also don't include that much detail. They provide for the actuarial assumptions to be prudent, the requirement that trustees adopt prudent actuarial assumptions and exercise prudence in the setting the contribution rates which are required to meet a scheme deficit. So much of the meat of the matter in terms of scheme funding falls back to guidance from the Pensions Regulator in the form of the DB funding code and the annual funding statements. So the Pensions Regulator has been given very wide powers to set the standard for scheme funding on an ongoing basis. Trustees and employers are required to agree the actuarial valuation terms, the trustees to set the actuarial methods and assumptions, and the trustees and employers to agree the recovery plan to meet any deficit within 15 months of the effective date of the valuation. And if that 15-month period is not met, if the agreement is not reached on those matters in 15 months, or if the regulator regards the terms set as not being sufficiently prudent, the Pensions Regulator has powers to impose terms on the trustees and employers. And that's again an area where the regulator has very wide powers to impose what is regarded as being appropriate and sufficiently prudent. And it's important to note that in scheme funding matters, it's not just the employers who could be held to be in breach of the legislation, but trustees also. Trustees, as well as employers, could be fined by the Pensions Regulator for being in breach of the legislation. Now, the statutory scheme funding legislation is, in addition to the protections which scheme beneficiaries, trustees have under the scheme rules. It's not a limit or a maximum on those powers. So it's additional to any unilateral powers the trustees may have in the scheme rules. And unilateral powers of the trustees to set employer contribution rates or to trigger a scheme winding up will provide useful leverage for trustees in many circumstances when dealing with corporate restructuring. Next slide. And the most recent statement issued by the Pensions Regulator in terms of annual funding was last April, the 2020 annual funding statement, which covers valuations with effective dates between September 2019 and September 2020. But the principles set out in that statement will be relevant to valuations having later dates than that. Also, the valuation, so the statement includes a matrix which considers the different considerations that trustees should take into account as regards valuations in terms of funding, covenant and investment. And the different factors to be taken into account depending on how well funded the scheme is, the strength of the employer covenant, and how mature the scheme is in terms of the proportion of pension liabilities. And the statement envisages that the average of a recovery plan to meet a deficit will be 7 years. So given that the technical provisions deficit will be met within that period, then the long-term funding target, which the statement requires and which the pension schemes bill will also require, envisages a higher funding target than technical provisions, typically a self-sufficiency basis under which the scheme would be able to meet its liabilities without employer support. The regulator also expresses concern in the statement and in other guidance documentation about covenant leakage, for example, where significant dividends are paid, or intra-group transfers and loans, for example. And there will be a new DB funding code coming out, which the Pensions Regulator will be issuing in draft and consulting on in the spring. And we know from the consultation that the regulator carried out last year that they're looking at having two classes of pension scheme, two classes of DB pension scheme. Firstly, a fast track type of scheme, which will be subject to the prescriptive requirements of the regulator, but will in return enjoy a low level of regulatory intervention. And on the other hand, bespoke schemes, which go for a scheme-specific approach, which is not subject to the level of prescription, but will then be subject to a higher level of pensions regulatory intervention. And given that we're looking at long-term funding, it's also important to bear in mind the ultimate end position of schemes in terms of buyout of liabilities, purchasing annuities with insurance companies. In that context also, it's important to bear in mind that employers are subject to employer buyout debts, both on winding up of a defined benefit pension scheme and also on insolvency of an employer or where an employer leaves the scheme. So next slide. So that briefly was an overview of the scheme funding legislation and then the Pensions Regulator's powers in relation to scheme funding. And secondly, I want to turn to the moral hazard legislation, and moral hazard in ordinary parlance is where you have a lack of incentive for someone to guard against risks to which they're subject because they're protected against the consequences. And that concept was used in relation to sponsoring employers of DB pension schemes before you had the buyout debt legislation and before the extensive pensions regulator powers to deal with moral hazard. But it seems to me that the pensions regulator powers go beyond mere moral hazard and intervene much more widely. There are two types of pensions regulator powers under the existing moral hazard legislation. Firstly, the contribution notice, which deals with so-called type A events, which are transactions which are regarded as being materially detrimental to the employer covenant and therefore to the DB scheme. We've got some examples on the slide there disposal of assets without full consideration, or granting new security which relegates the scheme in the priority order, or a change of control of the sponsoring employer. And the Pensions Regulator has got power to issue a contribution notice requiring contributions to the scheme against a very wide class of persons, not only covering the sponsoring employers, but also group companies, shareholders, and that's on a very wide Insolvency Act definition of control and associatedness and connectedness, involving a 1/3 or more holding of voting shares. There's also a power to go against individuals, directors and shadow directors individually of any of those companies. So as we can see, the Pensions Regulator's powers are very wide in relation to contribution notices, and they've got power to look back over transactions in the last 6 years. Next slide. And the other type of Pensions Regulator intervention in the moral hazard sphere is the Financial Support Direction, or FSD. And this involves, this is triggered where the sponsoring employer of a DB pension scheme is either inadequately resourced, in the sense that it has net resources of less than 50% of the employed buyout debt, or it's a service company, so it's a company which just provides employees for other companies in the group. And the effect of an FSD is to require employers and group companies to make proposals to provide additional support to the DB scheme, whether in terms of making sponsoring employers jointly and severally liable for each other's liabilities, or to require group companies to give guarantees of liabilities. But the FSD itself doesn't impose a liability to contribute. It's a requirement on employers to make proposals, and then the regulator has to approve those proposals for the FSD to be complied with. If the regulator doesn't approve the proposals, then the FSD is breached, and the regulator could issue a contribution notice. An FSD is linked to, is triggered by financial circumstances which exist in the last 12 months. But the regulator, in deciding whether to issue an FSD, can take account of transactions at any time. There's no real limit on the transactions the regulator could take into account. So they could even take account of transactions before the regulator existed. And the main constraint on the exercise of these existing moral hazard powers to issue a contribution notice, or FSD, is that the regulator can only issue those notices and directions where it is reasonable in the opinion of the regulator. But that is a very wide concept. It is a subjective concept, a matter of the opinion of the regulator, by reference to an unlimited number of factors, and it's difficult to challenge the view of the regulator as to what is reasonable. Next slide. So I've looked at the existing powers of the Pensions Regulator on scheme funding and moral hazard in broad outline. And now turning on to the Pension Schemes Bill, which has completed its passage before Parliament, and is awaiting royal assent, and that will give the Pensions Regulator even wider powers in the moral hazard sphere, as well as cementing the requirement for a long-term funding target on scheme funding. And one of the key areas where Pensions Regulator powers are extended is as regards the new criminal offences, and these relate to Type A events which are materially detrimental to the employer covenant and therefore to the DB scheme. And the new criminal offences will apply to any person who enters into such a materially detrimental transaction where the person knew or ought to have known of the material detriment. So the offences would criminalise mere negligence, and yet there is quite a severe penalty in terms of a fine of up to £1 million, or even 7 years in prison. And the Pensions Regulator powers are very much broadened because the new criminal offences are very widely drafted. There is no reasonableness test apart from the question of negligence. There's no limit on the persons who may be caught by the offence. The only exclusion is persons acting as an insolvency practitioner. The new criminal offence would catch all the persons who could be caught by a contribution notice or FSD and more, sponsoring employers, group companies, shareholders. Could even apply to trustees and lenders and advisors, as well as, of course, as directors of companies individually. And the one crumb of comfort which we do have is that Guy Opperman made clear in the House of Lords that the pensions bill itself and the new criminal offences will not be retrospective. So they will only apply to transactions carried out after the date of coming into force of the bill, which will be after the regulations giving effect to the bill and providing for the commencement date come into effect. So next slide. And the other main change under the pensions bill is to provide for new notifiable events and a requirement for an advance declaration of intent by planners of corporate transactions to the pensions regulator and the trustees of DB schemes. And this obligation will apply to parent companies as well as participating employers in a DB scheme, and covers the three main types of Type A event: a sale of controlling interest in a sponsoring employer, the sale of the business or assets of a sponsoring employer, and granting security on a debt, giving priority over the scheme debt. And the effect of this new advance declaration requirement is to get the pensions regulator involved at an earlier stage in corporate transactions. There was little detail in the bill about how this will work, but it seems to be clear that part of what will have to be notified to the regulator is details of discussions held with the trustees of the DB scheme about the transaction. So it still seems to be the case that the planners of corporate transactions will need to discuss the transaction with the trustees of the DB scheme first before going to the regulator. Next slide. Another change made by the bill is to bring in new tests for the contribution notice. As we will see, I'm not really convinced that these make much of a difference, but I'll go through them anyway in broad outline. They are similar to the existing material detriment test. The first new test is the employer insolvency test, and this involves the regulator being able to issue a contribution notice where a transaction materially reduces the likely recoverable employer buyout debt. There's a notional employer insolvency for this purpose, and the regulator estimates the amount of the employer buyout debt. There is a defence, as there is under the existing material detriment test, where due consideration is given by the target of the contribution notice to the question whether the transaction would materially reduce the recoverable employer debt, and it's reasonable to conclude there is no material reduction, or all reasonable steps have been taken to minimise the reduction, or indeed that there's no employer buyout debt by the time of the pensions regulator intervention. But as I said, that's a fairly similar framework and a similar defence as for the existing material detriment test. Next slide. And then the other new test for a contribution notice is the new employer resources test, and this would allow the pensions regulator to issue a contribution notice where there's been material reduction in the employer's resources relative to the employer buyout debt, and that's based again on a regulatory estimate of the employer buyout debt. And again, there's a similar defence as for the other two tests in terms of due consideration being given by the subject of the contribution notice to whether there's been a material reduction in employer resources, and it's reasonable to conclude there's no material reduction, or all reasonable steps have been taken to minimise that reduction. So it seems to be overall that these new tests give fleshed out further examples really of what's meant by material detriment. And I don't think that good practice in relation to whether there has been a material detriment and how to respond to it will be greatly affected by the two new tests. Next slide. So just consider the breadth of the pensions regulator's powers. It's also important to note that the general economic condition at the moment, given the COVID crisis and the continued lockdown, the government have given extensive support to business in terms of the coronavirus job retention scheme and the loan and grant schemes. There's been support in the area of pensions because the pensions regulator has been allowing employers to suspend or reduce deficit reduction contributions in appropriate cases for cash flow or other reasons. And the question arises when that support will come to an end. And as we come out of lockdown, as the vaccines hopefully work, we may expect to see some phasing out of support, and that will be the crunch time when we see the economic effect of COVID and lockdown. It's important to note the Pensions Regulator guidance on protecting schemes from sponsoring employee distress issued last November, and that gives guidance to trustees about spotting the signs of distress, financial distress for sponsoring employers, and urges trustees to make contingency plans to make sure that DB schemes are treated equitably in terms of where concessions are granted to creditors. Next slide. So to conclude my legal review, we've seen that the Pensions Regulator has wide powers in relation to scheme funding and moral hazard under existing legislation, and those wide powers are to be widened still further under the Pension Schemes Bill. It seems likely to me that the greater Pensions Regulator powers under the bill will lead to greater regulatory intervention in relation to higher risk DB pension schemes where there's a greater likelihood of the scheme falling into the PPF or being in deficit, as opposed to larger DB schemes where the scale of the amount of the risk is greater if it materializes, but the likelihood of the risk materializing is lower. So the question then comes, will the Pensions Regulator powers under the bill inhibit planners of corporate transactions to carry out necessary restructuring? And there is a risk indeed of that, depending on what the new guidance from the Pension Regulator says post the bill. So I'll now hand over to Dan and Nick to talk about future trends and take us further into the webinar. Thank you.
Thanks, Jeremy. Just before we move on, there's been a couple of questions come through, so thank you for those. Jeremy, I'll ask you one now and then see where we get to in terms of time and try and cover off some more at the end. So one question that's come through, under the Pension Schemes Bill, will sponsors now need to seek clearance whenever they're dealing with a corporate event that could be detrimental to the scheme?
Thanks, Nick. There's no requirement for clearance. Clearance is still a voluntary process, but because there's a requirement now on planners of corporate transactions to notify the regulator in advance of the transaction where it's seen to be a type A event, that may make clearance more attractive because the regulator has been informed anyway. Perhaps there may be a tendency to seek clearance whilst it's not clear how the regulator will use its new powers. But maybe as the dust settles, as time goes on and regulator practice becomes clear, there may be a reduced requirement for clearance again.
Thank you. Dan, over to you.
Thank you very much. Thank you, Jeremy. And picking up from some of the themes he's raised, we thought we'd have a look at some of the trends we expect to see in the coming year. I don't think any of you will be surprised to hear that we think 2021 and probably 2022 is going to be very challenging for the economy and as a result for many sponsors of pension schemes. So we certainly saw at the beginning of the pandemic that there were some significant affordability constraints for some companies in certain industry, or probably across the board to start with, and then certain industries impacted by COVID. And there were lots of DRC contributions, suspensions or deferrals requested. And we expect that as lockdown ends and as Jeremy points out, the government will start to withdraw its protection for companies and furlough schemes will end and CBIL loans will need to be repaid and that kind of thing. There will be difficulties for companies maintaining liquidity, and we expect to see an uptick therefore in DRC deferrals. But broader than that, what we hadn't seen currently is lots of restructuring insolvency. There has been some, particularly in certain industries like retail, but actually last year there were record low insolvencies because of all the liquidity pumped into the system. And in fact, the PPF had very low amount of new assessments starting next year. That is widely anticipated to change. Can't be exactly predictive of how much and when, but there will be an uptick probably in the second half of the year. And obviously that will involve a lot more activity for trustees and their advisors. Now, on the slight upside, in the silver lining, if you like, is that in situations like that where there's stress in the market, it does create opportunities, particularly for M&A activity. We do know that there are lots of PE funds and investors out there with a lot of money that they haven't been able to deploy last year because the circumstances were too uncertain. So there's money waiting in the wings, if you like, waiting to be deployed, and that will help at least avoid insolvency, we hope, but it will certainly involve restructuring. And there will be pressure on trustees to protect members' interests in those circumstances. We've put there that something that we've seen already and that's very much endorsed by the regulator is for trustees to start acting and thinking more like lenders. If you are, think of it in terms of if there is a DRC suspension, you're effectively lending money that's contractually due to you back to the company. If a bank was to do that, what would it do? How would it negotiate? You know, interest, upsides, that kind of thing. And that's a trend we think will continue. In terms of the actual restructuring solutions, we certainly think there'll be more CVAs, particularly in the retail sectors, and they may or may not compromise schemes, but they will be a popular way of restructuring companies because they're very much tried and tested. What you've had in 2020 through the Corporate Insolvency and Governance Act is the introduction of two new types of restructuring tool, the moratorium, which is effectively giving company breathing space from its creditors before it works out how to progress, and an arrangement which will often follow a moratorium, which is a new plan, which is not dissimilar to a CVA, but it has lots of classes of creditors and the ability to cram down creditors. We don't know exactly how these will be used, and they certainly were not created with pension schemes in mind, but we know that insolvency practitioners are desperate to try some of them out as part of the new rescue regime, and that will have an impact on pensions for sure. We think that RAAs will probably remain the exception. There haven't been many to date, not through the last recession. They are not easy to use. They take time, which is obviously of the essence in restructuring, and the rules around them are quite stringent and hard to meet. But we do think there'll be a rise, or at least an attempt rise, of what we call PPF plus deals, where a scheme, a sponsor is not able to get a scheme to full buyout because it's too distressed, but there's a possibility for at least to get better than PPF, and we expect to see people trying to get schemes to that level where they can either be taken on by a consolidator or a capital provider or through some sort of SWOS structure. Not easy, but we expect to see a push. And overall, we expect to see innovation in around pension solutions. Necessity is the mother of invention, and if it's particularly bad recession, we will see more of that coming through. And then finally, to go back to the pension schemes bill, we've already seen, even though it's not coming to law, the provisions drive sponsor behaviour. And if we can have the next slide, please. Certainly what we'll see is that, well, we have seen that just the threat of criminal or civil sanctions gets the sponsor to the table with the key stakeholders around the scheme, which is obviously a positive where they haven't been minded to do so before. We also expect that the new test, particularly the insolvency test, will drive requirement for more financial analysis to be done both by the sponsors, advisors, and likely the trustees' advisors to review it. And this will be done to sort of calculate if there's been any detriment to the scheme, potential detriment to the scheme, and how to quantify any mitigation. As ever, leverage will be important, and the trustees will want to get a seat at the table, and they may have it through powers or security, but certainly just the civil and criminal impact for sponsors and their advisors in itself gets the trustees some leverage and a seat at the table. Because what we think is that whatever happens, even if there's a robust defence to any action taken by a company, particularly in a distress situation, they will have to clearly evidence that they've taken the scheme's interests into consideration to be fundamental for any defence for them. That said, trustees, though, will need to be proactive, and you have to ensure that there is clear and consistent communication with the sponsors, and you have to understand the risks to your scheme. And with that, I'll hand over to Nick to talk about contingency planning.
Thanks, Dan. So, given what we've heard, what can trustees be doing today for all schemes? And the importance is being prepared, I guess, is the key message. What we've set out here is a kind of 4-stage process to how to think about contingency planning. This very much draws on the regulator's guidance that Jeremy referred to around sponsoring employer distress that came out in November. So first of all, really basic, but really important is understanding your current position. And that covers all aspects of the scheme. And specifically on covenant, there's a couple of things. I mean, first of all, understanding the scheme's access to value on an ongoing basis and the outcome for the scheme and other stakeholders on insolvency. So thinking about access to value is also about what's the confidence that that value is protected under different scenarios. So for example, does your employer benefit from valuable assets that the group relies on? Does it have valuable financial links with more valuable, larger group entities, for example, intercompany loans that can extend that access to value further? On legal powers, very much Jeremy's area of expertise, but commercially, the really important thing is to think through when and how you would actually use those powers, any unilateral powers that you have as a trustee board. So for example, and this plays to a question that's come through, would the trustees ever pull the plug? I mean, I think we all agree it's very unlikely to be in anyone's interest in the vast majority of situations. But where there's high PPF drift, and there's a likelihood that the scheme's funding position is only going to worsen over time, then triggering wind up has to be one of the options across the broad spectrum of options that the trustees have at their disposal. It has to be considered and tested as part of that wider process. Stage 2, planning and preparing. I mean, again, sensible to revisit the journey plan that you have as a scheme to see whether it's achievable. Really key for me is what we've seen on cases is wargaming scenarios ahead of time. So thinking through how would a restructuring play out? What will other stakeholders look to do, be that shareholders or lenders? When and how could we use the influence of the regulator as needed to get involved in those discussions? And I guess the real principle of that is those scenarios and that scenario thinking can help to inform what quick wins you can get today as a trustee board to improve the likelihood of a good outcome in the future. So a whole range of things you could consider in that scenario, negative pledges, other scheme protections, looking for guarantees that might not have any value in a worst case insolvency, but that can help get you a seat at the table in any future restructuring talks. Also, structurally, for multi-employer schemes particularly, ensuring that the scheme liabilities are attached to the strongest employer. So through a joint and several provision, etc., that can also make quite a big difference to the outcome. Stage 3, monitoring those plans. It's important to strengthen the information sharing protocols, engaging regularly with management. Again, what can make a difference is making sure that those information protocols are formalized. What we often see in the run-up to stress situations is a change of management. What you want to make sure is that information flow isn't lost once that change happens. What we typically look for is, from the company's perspective, is to at least provide the scheme with a similar level of information as other key stakeholders get, for example, lenders. And I think, touching on the points that Dan mentioned, the pension schemes bill is likely to incentivize companies to give that regular open dialogue and information with trustees. So hopefully that's something that we'll continue to see more of. And then finally, just on the monitoring, increasing the frequency of monitoring the covenant as things change, being very clear on your trigger points for when you would take action as a trustee board. And then finally, stage 4, like any plans, it makes sense as circumstances change, you revisit those plans, you adjust them as you need to. It's a dynamic process that we're looking for, really. So that's contingency planning. What Dan and I are going to do now is turn to some case studies where we kind of talk through some of these themes and how we've actually seen them play out in practice. So over to you, Dan.
Thanks, Nick. So the first case study we're going to look at is a CVA that we did last year, where there was an international retailer, an obvious sector for distress. And the key themes coming out of this that I think will be trends for the year. One is around the issue of PPF drift and how you deal with that in a restructuring. Equitable treatment from the perspective of the PPF and the regulator of the scheme. And also in this one particular, issues around leverage and knowing your scheme and good contingency planning. So this was introduced to us. The company was in significant distress, and it was going to propose. It had proposed a CVA, at which point many of you will know that the PPF takes an interest, and it has this Section 75 liability becomes the creditor from the scheme that will vote the CVA. And a CVA needs to have the support of 75% of its creditors to be passed. And because the scheme is usually a significant creditor, it needs to be dealt with appropriately. Now, the idea here was that from the company's perspective, the scheme is going to be left intact, and they were just asking for support. Now, one of the issues here was that actually the scheme was quite well funded. It was currently in a PPF plus position, but there was significant drift. There were no DRCs being paid. We came in, did a very quick covenant review, and unsurprisingly, we decided that it was a weak covenant because they're about to go through a CVA or go into administration if that wasn't passed. And really, the levels of DRC should have not been zero. They should have been higher, at least to cover drift. So there was automatic disconnect between what the company thought the scheme position was and what it actually was. And part of the reason of that disconnect was that the trustees had not done contingency planning, even though it was in the retail sector. And actually, we had a lot of work to do when we came in to find out what the scheme position was. And in fact, we found out that the scheme had a unilateral contribution power, which obviously is significant leverage, but the trustees weren't apparently aware of. Now, one of the good things they did was immediately appoint an independent trustee. In fact, that's preceded our appointment with experience of distress, and that helped change the dynamic completely. And fortunately, we were able to get up to speed quickly enough so that the lack of preparation didn't impact the outcome. So the two drivers for getting a result that the company wanted, that the scheme wanted, which was to cover drift and to be treated fairly, which I mentioned, was the fact that we had a significant vote. It wasn't exactly clear whether we could stop the CVA from going through, but because of the uncertainty, the company took us seriously. And because we had the unilateral power, even if we were voted down, we could come back to the table afterwards and say, hey, we want some money. So the equitable point was that one of the significant creditors of the company was its parents. There was a big quasi-equity loan that it had made, and the PPF insisted that that in the event that the CVA failed, any monies that the parent company had received in that period were in fact held on trust for the scheme and repaid. So that's the key theme of equitable treatment. So leverage is key, PPF drift will be key, and being treated fairly will be key. I don't know, Nick, if there's any questions, or do you want to go straight to the next case study?
Just conscious of the time, Dan. We'll carry on and try and pick up any right at the end if we've got time. So just on case study 2. So this is looking at a deficit contribution suspension. As Dan mentioned, we're expecting to see many more of these, and they've started to sort of come back in the second, third wave of COVID. So this was a situation with a consumer-facing business impacted by COVID around March, April time, leading to concerns around cash flow and liquidity. The trustees were asked to suspend DRCs for at least 3 months, but more likely 9 months. We advised the trustees on the reasonableness of that request and the need for it from a company perspective. What was really challenging here was time was very limited to agree a deal. The regulator's guidance had come out around what trustees should be doing in these situations, which was interpreted very differently by the company and the trustees. And this was a scheme, a large scheme with a significant underfunding position. So the scheme ultimately really needed those deficit contributions. Where we got to in terms of an outcome was that 20% of DRCs were deferred, 80% placed in escrow subject to specific covenant triggers. And the good result at the end of it was that company performance improved. And in the end, 100% of those deficit contributions came back to the scheme within a period of about 6 months. So when I kind of look back at that case, what really made a difference? I think, first of all, robustly assessing the company's need for cash and when it was needed under specific scenarios. In this case, it was clear the company had good liquidity for a period of 6 to 9 months. It wasn't an immediate need that we were looking at today. Equitability, really important. How are other stakeholders leaning in? In this instance, lenders were not being asked to lean in necessarily. The company was resisting drawing down on its unutilized credit facilities or compromising any position for lenders. Shareholders were seeing dividends suspended. Employees and management were taking up to a 20% pay cut. And that was the kind of rationale for the 20% of deficit contributions being deferred for the pension scheme. Scenario planning, really important. We looked at sensitizing the forecasts around how does the scheme and other stakeholders fare in an upside scenario, in the base case, and in a downside scenario. And it comes back to the theme that we've talked about a couple of times, thinking and acting like a lender. What, in this situation where the DRCs are so important to the scheme, what can we trade in respect of those DRCs? So interest, we agreed a deal whereby the pension scheme was compensated for the lost investment return on those DRCs. Security, in this case, came in the form of guarantees, where effectively entities that we identified that had real tangible assets within them and some real value, and where we were able to sit alongside lenders as creditors into those entities. And then finally, share of the upside came in the sense that those funds in escrow were repaid to the scheme if company performance improved. And I think, as I say, looking back at the process, what we did at the start was we conducted what we call a pre-mortem to say, if the situation turns out better than we expect, will we be seen to have conceded and compromised too early and unnecessarily? But equally, and probably more importantly, if the downside crystallizes, would we be seen with the benefit of hindsight that the trustees and advisors were resisting any requirement from the company and actually helped to accelerate any demise and shortage of liquidity? So ultimately, where we got to is what we need is a flexible win-win solution. And as I say, it turned out well in the sense that company performance did improve and the scheme benefited from that. Dan, do you want to just quickly cover the final case study before we wrap up?
Thanks, Nick. Very quickly. So this one was recently, actually, there was a restructuring of a large brewing and hospitality company. And again, the theme here of equitable treatment and PPF drift comes to the front. You had a situation where the company needed to financially have financial operational restructuring, or the alternative was administration. And in this particular case, it owned over 150 freeholds. And the idea was that instead of operating the pubs themselves, it would actually get a new tenant, an investment rated tenant, and the company would effectively become a landlord. And then once the covenant of the rental income was secure, they could sell down lots to the freeholds, repay the bank, and have sort of a rump company that supported the scheme and the rest of the business. The leverage here was that this change of sort of material purpose of the company to go from an operator to a landlord actually triggered a winding up power that one of the schemes had, and therefore for this plan to go ahead they needed the trustees approval. And what the trustees asked us to do was to assess whether actually on balance it was better for the members to continue for the company to go ahead, or whether actually administration was a better option for the members. And the PPF and the regulator had a lot of influence on that. Comes back to this point on drift. So again, the DRCs were not enough to cover PPF drift. And the significance of that, someone asked the question, is that actually in a situation where the PPF is going to be worse off by waiting, they have a preference to pull the plug. And if it has no difference or little difference to members, say for those who happen to be retiring in the next couple of years, which is not insignificant, but the PPF puts significant pressure on trustees not to go forward in these situations if there's going to be significant drift going forward. And in this particular situation, actually administration was not necessarily fatal from a PPF's perspective. It was never going to get the members full benefits, but actually there was potential that the recoveries from the administration would actually get the PPF paid in full or better. So they needed to be convinced, as the regulator did, that this company's plan was in the members' interest. And the way we got them comfortable was to negotiate with the company to say you need to cover the drift over the next couple of years while the plan is being implemented. The scheme got more robust security over the remaining properties. Actually, one of the key things was that the increased DRCs to cover the drift actually were ranked pari passu with the banks. Even though they had the first charge, they agreed that would rank alongside them. That's something that the regulator was very keen for in terms of treating the scheme equitably. And we knew that the banks had more of an interest in the company staying out of administration. There was more likely to get out in full. So they had reason, we had leverage there to drive that. And even though we weren't expecting them to say yes, on the old adage, if you don't ask, you don't get. And they said yes. And that was a very important win from the regulator's perspective. In terms of one other key point is that the negotiations could have gone quicker if the company had their own pensions advice. Firstly, because they only realized at the last minute the trustees had the power, so that actually put leverage into the trustees, but also they didn't understand the scheme dynamics. They didn't really understand drift, and that's slowed things down, but we got there in the end. But some interesting learning points from that, which we think will continue. And if we have the next slide, I will just wrap up and hopefully we'll have some time to take at least one or two questions. So looking ahead, obviously the main challenges for sponsors and schemes are going to be caused by us coming out of COVID and Brexit, which is slightly underreported, but certainly having an impact on certain businesses in the company. And all of this there'll be significant competing tensions between the sponsor and the scheme. The sponsor is going to have to contend with slowed down economic activity and problems around liquidity and trading. And you've got that, the other end, the pension schemes are putting more pressure on sponsors to bring the schemes into play. And that's going to be a tough dynamic. And the importance, we think, is for all parties to come together and find win-win solutions. Sounds obvious, but in the heat of the battle, that's not going to be easy. But one of the keys tenets to that is education of sponsors, how schemes work, and getting the right advice for them, and education of trustees, how restructurings work and the dynamics around that. And then the final thing I'll say is that on the plus side, professionals in these situations have always been good at finding creative solutions. I've used Halcro and Unique as examples there, where compromises were found. And we think the next year or so will drive that innovation. Sorry for rushing that, but I'm conscious of time, and I wonder if we've got any time for questions.
A question has come in on case study 2. Did the escrow mechanism provide full security in the event of insolvency? And how did the company and trustees interpret TPR guidance differently?
Yeah, I'll take that. Thanks, Jeremy. So the escrow was an account in favour of the trustees who had full security over it. So yes, on insolvency, it was an asset of the scheme, importantly. How the trustees and the company interpreted the regulator's guidance differently, I would say the company, like a lot of other companies, interpreted it as a blanket rule to say effectively the regulator giving the trustees the okay to agree to a deficit contribution deferral almost under any scenario. And I think the trustees and how we looked at it was it had to be a very scheme specific solution. Given the high level of risk with this particular scheme in question, it was a very different case to others where schemes would be very well funded and those deficit contributions were nowhere near as important to the scheme. So scheme specific, I would say, was the way that trustees were required to look at it.
Thank you, Nick. I've got another question on case study 3, which just come in. We find, this is from Costas Yusumi, we find PPF drift can make a massive difference to some members for schemes with more than 100% on PPF funding, and hence tension between trustees looking after interests of members and the PPF looking to protect PPF levy payers. Did you find that the PPF was quite single-minded in focusing on its own interests?
The way I put it, look, both in case study 3 and case study 1, this was an issue, and the PPF did hone in on it, particularly on case study 1, where they had the vote. It was of huge importance for them. And even where it was the trustees' decision whether to go forward or not in case study 3, in light of the views expressed by the regulator and the PPF, it's very difficult to go it alone when you know that there's a contrary dissenting view, and it is a source of tension because members want the scheme to continue. Of course they do. They're not cognizant of PPF drift. If there's a big gap between PPF funding and PPF plus, and it's never going to get there, the members just want to survive as long as possible so they can get as much. Those who are retiring can get as much as possible. But we have seen that the PPF are willing to take stringent steps to stop that, actually, and will withhold support if they need to. So it's going to continue to be a very important point going forward.
Thanks, Dan. Thanks, Nick, as well. Thank you for your time in listening to the webinar. I hope you find it useful from both a trustee and an employer perspective as we go forward in these interesting times. So thank you very much for your attention and thank you for your questions as well. And I'm sorry we didn't get back to you on all your questions. We will get back to you individually on those questions we haven't answered. Thank you. Goodbye.
Thank you, everyone. Bye-bye.
Bye.
Thanks all.